Hey everyone, Sam here. You should be able to hear okay and see the screen. Let's get started. Yes, Michael, we will definitely be looking at live charts in just a bit. We've got a few things to go over first, and then we will certainly look at live charts. We've got many markets to go over, a bunch of supply-demand opportunities, and so remind me that one in just a little bit. All right, and if anybody has any questions, obviously just ask. That's what I'm here for. And if you want, more information beyond our session today, you can always come to one of these workshops. If you're brand new to trading, you might want to come to the regular workshop. If you have experience, you certainly want to come to the advanced workshop. So there, we'll certainly take things deeper than we have time for today. But we'll get into a lot of the important stuff when it comes to today's topic. All right, and there's a link in the chat if you need it. Okay, so what we're going to talk about today is really the reason why the majority of active traders lose money. Did everybody see today's topic? Make sure we're all on the same page. Okay, so let's dive right in. Okay. And so first thing I'm going to do is, instead of diving right into that question, let's go over how markets really work. Okay. So we talk about the Pinnacle method. We're talking about the governing dynamics of supply and demand, how markets work, the supply-demand strategy we've been covering for years here in the FX Street sessions. Starting all the way on the left, right, we have supply or retail prices, right? Competition to sell at supply forces price down because of a significant supply-demand imbalance, right? At supply, supply exceeds demand. The best supply zones have the greatest imbalance. The larger the supply-demand imbalance on the supply side, the more competition there is to sell. That's what it means. And that competition to sell forces price down. Does everybody understand why that happens? Okay. What happens? So you see the little green here, right? The demand side. What happens at this price point once all of these buy orders are filled? Well, then we have a significant amount of supply left over, no one left to buy at that price point. That's going to force price lower. That competition to sell at a price with no buyers is going to drive price lower. That's what it does. It pushes price lower. The picture that represents that is one of two things, and here's one of them here. Some trading, price drops, doesn't come back. We'll dive into this more in just a little bit, and we're going to look at live markets today. The probability of price turning lower at our key supply zones and the profit zones in those areas are ideal. They're significant. Okay. Now remember, we have supply and demand everywhere in the market. Every price point, every trade that happens, it's all because of supply and demand. I think we all know that, right? Meaning every time a trade happens, it's because a buyer and a seller agreed on a price, agreed to buy and sell at a price. Every time you have a tiny move up in a market, it's because demand exceeded supply at that price point. Every time you have a very small or large move down in a market, it's because supply exceeded demand at that price point. So supply and demand is everywhere. When we don't, the majority of those supply demand imbalances we don't care about. What we care about and want to identify are the price points in any market that have the greatest supply and demand imbalance. Why? Because that's where the probability of price turning is highest. Down at demand, another word for demand, wholesale prices. Okay. At demand, there is competition to buy because of the significant supply-demand imbalance. Once all these sell orders are filled, you have a large amount of demand left over. That competition to buy at a price point where you don't have any more sellers is going to drive price higher. Okay. There is a certain picture that represents that level of imbalance on a price chart. We're going to look at that today. In the middle, right, we call that fair value or relative balance. We don't call it equilibrium because it's not equal, right? It's always an unbalanced equation that takes time to play out, right? But relatively, you have relative balance in the middle. It's certainly where the highest trading volume is always going to be. Why? Because the majority of buyers and sellers agree to buy and sell here. It's a lack, and that's because there's a lack of a significant supply-demand imbalance, where you have huge imbalances out at supply where we're looking at, right, or down here at demand where we're interested in. You have a lack of those significant imbalances, and that's why so much trading activity happens in the middle. Does everybody understand this so far? Everybody clear? What that picture looks like on a price chart is very clear and very easy to identify if you know what you're looking for. Again, it's always going to be the largest amount of actual trading volume or activity. So that will be represented by lots of candles or lots of bars or lines in this price range. The wide and whippy trading activity here is also evidence of fair value. And think about it. If you had a significant supply-demand imbalance anywhere inside this range, would the picture look like this? Okay. Would the picture look like this? No, it wouldn't. You'd have very little trading. Price would shoot away and not come back. Mombre, yeah, you should be looking at the governing dynamics slide. Okay, the picture. We also call it the novice space. Why do we call it the novice space? Well, because only a novice market speculator would enter a position in the middle. The probability of success is low. The profit zones are not ideal. And it's very difficult to manage risk when you're buying and selling where the majority of people buy and sell. The probability of price turning and be able to predict market turning points with a high degree of accuracy is very low in the middle. I want to make sure everybody understands that. At supply, you have the largest amount of potential volume by far, but you don't actually get that volume because all that volume, potential volume, is on one side of the market, and that's what drives price lower. Same thing down at demand. You don't actually get all that potential volume because it's all on, the majority of it's on one side of the market, the buy side. Okay. So competition to buy at demand and sell at supply is always pushing price back to the middle. Fair value, which is where the majority of market speculators, traders, right, buyers and sellers, where the majority of people agree to buy and sell, is always pulling price back to the middle. So it's this constant push-pull concept, right? Any questions on this? I mean, we're just explaining how markets have always worked in the past, how they work today, and how they'll always work in the future. It's always just pure supply and demand. We're talking about the trading markets, of course, but it's any market. We could be talking about the market for almost anything you could think of. Okay. Now, I want to share something else with you here, right? So if we agree that, you know, supply, demand, fair value, and all that, that this is how the markets work, right? Let's now look at how the majority, you know, why are so many people not successful? Why do the majority of active traders lose money? It's because they think this simple supply demand governing dynamic of markets backwards, right? They literally think of it backwards. instead of buying at demand and selling at supply and staying away from the middle or fair value. And before we go on, again, what we're looking at here, isn't this how, if you're in really almost any business out there, how you make money buying and selling anything in life is exactly how you make money buying and selling here in the markets, right? If we were talking about Costco or Walmart or Goldman Sachs or JP Morgan or really anybody, they buy at wholesale prices and sell at retail prices. That's how they make money. That's how we do it in the financial markets. As a trader, investor, swing trader, day trader, doesn't matter. But now let's look at what do active traders do? How do active traders think? Now, I started out on the trading floor of the Chicago Mercantile Exchange, working on the professional side of the business, and I was on a trade desk handling institutional order flow. So I got to see at the level of transactions or orders, right, what banks and professionals were doing. In other words, how they made decisions to buy and sell, where they bought and sold, and at the same time, we also handled, retail, your average trader or investors, some of those orders as well. So I got to see how that group decides to buy and sell and where that group buys and sells. And what you see is fascinating, right? One group is very successful, the other group is not, yet they're both buying and selling in the same markets. So watch. Let's go through some of the most popular strategies for the average trader that are out there in the world. And let's talk about strategies that have been around for, 50, 100 years and the strategies that still dominate the internet today, trading books, trading schools, you name it. Okay. How about trend following? Anyone that uses trend to make their decisions to buy and sell. Okay. Let's run through the mechanics of how that work. The trend trader does not look to buy at demand or wholesale prices. They wait for prices to turn higher at demand. They wait for a series of higher highs and higher lows, and then they buy. They don't look to sell at supply. They wait for prices to get to supply. They wait for prices to turn lower, and they wait for a series of lower highs and lower lows, and then they sell. That's what trend trading has you doing. So by definition, someone help me out here in the chat. Where is the trend trader entering their positions? At demand, wholesale, or supply, retail, or in the middle, in the novice space? Right in the middle. Right in the middle. How about people that buy and sell based on news? Right? If you think about it, and this is how a lot of people are trained to buy and sell in markets, and it starts at an early age in school, right? Grade school, high school, university, grad school, it's all the same, right? When you're taught to buy stocks are what most people buy and sell around the world, right? That's what the average person does. How's the average person taught to buy a stock, right? It all starts through our development years in school. Make sure it's a good company with strong management, healthy balance sheet, and for sure, make sure earnings are good, right? And what about the trend of the price of the stock? Is it supposed to be an uptrend or a downtrend when you buy it? Better be in an uptrend, right? That's the rule. Well, I could keep going with this list, but when all of those things are true and present in the stock or any market you're buying, where is the price of that market? Is it at demand or supply? Is it at wholesale prices or retail prices? It's almost always at or near retail prices when all of those things are good or true, right? When the news is really good, everybody buys, right? When the news is bad, most people sell. That's not what the Wall Street professional does. Okay. How about people who use indicators and oscillators, moving averages, all those tools like CCI and Bollinger Bands and stochastics and all this stuff, right? Right. Think about it. All of these indicators or oscillators that you can use to make buy and sell decisions in the markets, right? They all lag price, right? A moving average just lags price by however much you want to lag price by. All of them do. So if you think about it, like in this case, instead of buying at demand when the risk is low, reward is highest, and probability is high, right? If you're waiting, for example, for these moving averages to cross to the upside, which is a very popular strategy for indicator-based traders, this is where you're buying, way up here. In other words, your risk on the trade has almost tripled, and your reward is certainly less. The indicator-based buyer and seller in markets, where do they enter positions? At demand, supply, or in the middle? What's the answer? In the middle, right? Adding any tool to your decision-making process that lags price only increases risk and decreases reward. Okay. Well, Mark, look, the majority of people, don't even come across, don't even think that markets, they don't think markets the right way, right? Very few people think of supply and demand out there when it comes to markets. I mean, the trading markets, right? This is what most people do. If you Googled, trading education or how do I trade, this is the stuff you're going to get. Wait till you see what I'm going to show you in a minute. Next, let's look at chart patterns, technical analysis chart patterns. Exactly, Sam Bragg. Yeah, exactly. So anybody have a favorite chart pattern? And don't be afraid to mention it in the chat. I know some people are probably not going to, because I'm going to kind of beat it up a little bit. And I'm not here to really beat anything up. I'm just here to speak the truth about how markets really work and why the majority of traders lose money, why the majority of investors don't achieve their financial goals. All right, so support and resistance is one, Mark. What about the chart patterns like head and shoulders and double bottoms and cup and handles and all these things, right? Think about it. Let's look at one or two here. Here's one where we have right? This is your kind of W bottom or your double bottom. One of the most popular chart patterns in history, still in all the trading books. You can Google this one. You'll find millions and millions of results. Here's one bottom. Here's your second bottom. And when you have that, you're supposed to draw this line here called the neckline. And then when price crosses above the neckline, what are you supposed to do? You're supposed to buy. That's what the rule says. Right? What's the glaring problem with not just this right here, but all of these? What's the big problem? Can you start to understand why most people are not successful at this? Very late. You're always buying after a big rally in price. You're always selling after a big drop in price. Right? Here's the biggest question that matters. Would you use any of these strategies to successfully buy and sell anything else in life outside of the trading markets? If you had a business where you bought and sold things, or you worked at a company where you bought and sold things, or you were just buying and selling things, would you be able to use any of these strategies and be successful? And if the answer is no, then why would you use them here with your hard-earned money in the markets? Does that make sense? Okay. Take a look. So this is and we're going to get to the live markets here in just a few minutes. This head and shoulders, which is another chart pattern, which is very popular out there. in the trading and investing world. When you look at head and shoulders pattern, now I took this screenshot. We took it. It's right off of it's right out of an education center from one of the biggest brokers in the world. Now we covered up who it is. Oh, here, hang on a sec. Well, anyway, didn't cover that part. But anyway, and this is not to pick on them. This is every broker out there. Not every broker, but most brokers have this, right? Right? Look at the head and shoulders top. You got all the rules and all the information about it. Okay. So you're supposed to identify this shoulder, the head, the right shoulder. Okay. And then there's the neckline. And then when prices break down through the neckline, you're supposed to sell right here. And here's an example of a setup, right, in a market with the same thing. And you're supposed to sell down here. What's the problem with the pattern? Yeah, Sam Bragg, over the years, I don't know. This is what people do. You're selling after a giant drop in price. And even if price keeps going, which it will sometimes, how do you manage risk against that? That's another big problem. Okay. You can find plenty of these where price will keep going, but you know, does that mean you're gonna be successful with that? Most of these they won't keep going, but a lot of these, some of these they will. But that, how do you manage risk against that? It's terrible risk reward. Right now, so if you look at this example right here in our program, this is the same example. We actually had this one. Okay, only there was a supply zone. See this supply zone right here? It's this one. So we had a supply zone up here in our program. We give our members supply and demand zones every day in a ton of markets, stocks, futures, forex, all that, bonds. Anyway, price rallies up to the supply zone. We sell short with a protected buy stop just above the level. Whoops, and then a profit target, below at demand. Anyway, in this example, right, or this is actually a real one that we had. Price turns lower at supply and then breaks this neckline. Down here is where the head and shoulders people start selling. So instead of selling up here, the vast majority of people are trained to sell down here. Does that make any sense to anyone? And why would you do that? Right, exactly. So I want to walk you through. Well, before we do that, take a look. Whoops. Hang on one second. Let me just share something else with you here. Give me 1 second. And let me just share this with you. I want to bring something else up to show you, and I think it will help with all this. Okay. So take a look. You can see the screen again. So again, like we've talked about before, everybody can see the screen. So we asked Google, what percentage of traders lose money? Google says 96%. I don't know if that number is accurate or exactly accurate. Probably not. But either way, even if it's way off, it's still way too high, right? Whatever the number actually is. And then we asked Google, what are the most popular trading strategies? Google says the top one is trend following strategies, right? Scalping, Fibonacci, all these things. Okay. But look at that first one, trend following strategies. Right? We talked about that one. Does everybody understand now why, if you want to try to not be in this big group of people that lose money, what is one of the top first things that you can do to to make sure that doesn't happen? What should you eliminate from your thought process or your strategy? Yeah, just stop trend trading. Right? Stop waiting for prices to go up to buy. Stop waiting for prices to drop to sell. Now again, don't just go buy and sell anywhere. Make sure you understand the whole supply demand concept. Make sure you're very good at it and you understand how to manage risk before you put any money at risk in the markets. Obviously, right? So, but it's a big number and it's a real number, right? So, now you can see why, this is what most people do. If you look at the entries into markets, you're there, they all lead to entering in the middle in fair value. The other thing that all of the most popular strategies in the world have in common, they all make sure that you don't buy at demand and that you don't sell at supply, right? Anyway, I remember when I started at the Chicago Mercantile Exchange many years ago on the trading floor, I thought I was kind of excited. I'm like, "Ooh, I'm going to learn the big secret of the professionals. How do the Wall Street pros make so much money?" Well, the big secret isn't a secret at all. So what I quickly realized was, wait a second, what they know that and how they think, which everybody else doesn't, is that how you make money buying and selling anything in life is exactly how you make money buying and selling in the financial markets. But these strategies right here, the most popular strategies in the world, ensure that you don't do that, right? And that's why these numbers are so high. Okay. All right. Let's keep going. So there's those examples. Now, I want to share with you again. Let me share with you this. So let's take a look at, you should be able to see the screen. There you go. So now let's take a look at, today's Tuesday. And let's take a look at what we've done in our program over the past couple days. The reason is to demonstrate, what we're talking about here. Okay. So I do a live morning session every day for our members. So this was a setup. We went over this demand zone I believe it was last week, right? So we had a demand zone in the S&P, and we're going to look at stocks, futures, and Forex here over the next few minutes. So last week we had a demand zone down here in the S&P. Sunday evening when the futures markets opened, Sunday evening into Monday, the S&P came down to our demand zone and rallied, right? Remember, competition to buy at demand pushes price higher. Make sense? And why are we focused again on buying at demand? Because focusing on where prices are going to turn is the only way to attain the low risk, high reward, and high probability entry point into a trading opportunity or investing opportunity. Again, whether you're day trading, swing trading, longer term investing, and any asset class, it doesn't matter, right? That's how you attain the low risk entry. So prices started the week at demand and moved higher quickly, as they should. With that, stocks like Cisco came down into our demand zones and rallied. Disney came down into our gap demand zone and rallied. Okay. But then yesterday, the 5-year note, which is an inverse market, we look at the 5-year and some others as inverse markets to equity index markets or stock markets, this is from yesterday, we noticed that we had a qualified demand zone and a qualified supply zone, wholesale prices, retail prices, right? And if the 5-year was going to come down to demand and rally, that was likely going to push the stock market lower, right? It's an inverse market to the stock market. the way that we use it. It's not always an inverse market. We just have to follow specific rules. So the 5-year came down to demand and rallied. And when that was happening, that's when the S&P rallied from our demand zone all the way up to a supply zone that we saw in a different time frame. Right? So this is where our supply was likely going to be in the S&P. This was yesterday. Make sense? So price rallies from this demand zone all the way up to this supply zone. And again, some inverse markets came into demand here. Therefore, competition to sell its supply pushes price lower and the stock market falls. Right? Another way to say all this, we're just identifying wholesale prices and retail prices in the financial markets, which is what you do in any market. As the stock market falls, the S&P, so does the DAX from a qualified supply zone. All these big stock markets around the world, almost always move in the same direction. Right now the Russell's a little weaker than other markets. The Nasdaq's a little stronger. We'll get into live markets in a few minutes. So as the stock markets began to fall yesterday from supply, so did some stocks like Facebook. Facebook hit a supply zone, right? So it's this whole ebb and flow from demand to supply back to fair value. That's how markets always work. Okay. The forex markets are no different. Okay. This was a session. We have a forex session every Sunday evening to get ready for the week. Notice this market, the Swiss against the yen, gapped down right into a qualified demand zone, right? Where banks were clearly buying this market. That competition to buy pushes price higher up to qualified supply. What ended up happening in this market, price went just a little bit higher and then fell all the way back down to demand. Make sense? All right. Now again, it's always important to think of who is on the other side of your trade or transaction. Remember, if you take this opportunity, if one of our members or anyone, me, takes this opportunity to buy down here at demand when the risk is low, reward is high, and probability is high, think about who you're buying from. Who is the seller here? You always want to think about the person on the other side of your transaction, whether it's a day trade, swing trade, longer term investing. Who is the seller here? We don't know what their name is or anything like that, but we know how they think. The seller here is making a few mistakes, and these mistakes are very consistent among consistent losing traders. Mistake number one they're making, they're selling after a big drop in price. And not just after a big drop in price, but after a big drop in price and a gap down after that big drop in price. That's a big mistake. Second, they're selling right into a price level where demand exceeds supply, where banks are buying. Okay. You just have to ask yourself, what side of that trade do you want to be on? Right? Just focus on the actions of the buyer and the seller and ask yourself, which one is making the right decision based on how you make money buying and selling anything in life, right? Okay. So does that make sense? Does it, and this is not to say, look, there's not every trade, not every investment is going to work. You're going to have, everyone has losses. So the key is to understand how to manage risk properly. Enter markets when risk is low, not after it turns when risk is high. Enter markets when your reward, the distance to your profit zone is big, not after price turns and it's smaller, right? Remember, there's only 4 outcomes to every trade. It's a small win, a big win, a small loss, or a big loss. If we just eliminate the big loss, we can certainly live with the other 3, right? Okay. Well, hopefully you understand again why the majority of people lose money trading. It's because again the strategies that they follow are so backwards when it comes to how you make money buying and selling anything in life. Remember, the trend trader is not buying here at demand. They wait for prices to go up and then they buy. The indicator and oscillator based trader, like we just saw, doesn't buy at demand because all those indicators are pointing down. Right? Once price turns and goes higher, that's when they're going to start turning higher. So the indicator based traders not going to buy anywhere near demand. And I could go on and on and on, but I think you get the point at this time, now. So let's with the time we have left, let's go into the live markets and let's take a look at some opportunities. I can look at any market, but we can certainly look at some Forex markets. We've got plenty of opportunities to go over. Why don't we start with the dollar? The dollar is a key. Yep, Michael, we'll start with the dollar. The dollar is it's a great market to focus on for many reasons. It's a great trading market, but it's also an inverse market to equities at the right supply and demand zones. And obviously, it's a big inverse market to the euro because that's how the index is made up, and other FX markets against the dollar. So when we look at the dollar, and I know we may not have looked at this in about a month here in the FX Street sessions, but you can see we've just been trading from our weekly demand to weekly supply, and we're much closer to this one now. Notice prices have not gone deep into the supply zone, suggesting there's still a big supply-demand imbalance here. And remember, like I kind of said this before, but just to make sure everybody gets it, the strategy we're talking about here, we apply equally to any asset class: stocks, futures, Forex, bonds, options, real estate, you name it, crypto, doesn't matter. And then in any time frame or financial purpose, meaning day trading, swing trading, longer term investing, it doesn't matter. So working our way down to look for more evidence of the supply and demand zones that have that significant supply demand imbalance, let's go to this larger time frame up here. Right, this is a level that we've had. We're coming up here again. So we've been here once. We went pretty deep into this level. So we probably wouldn't take this exact zone again. In fact, we wouldn't. But sitting above that, 93.40, we have a fresh demand zone. So fresh is key, meaning since price moved away from the level, price has not been back to the level. Okay. And meaning, the supply there has not been used or filled yet. So probability of price turning at a fresh zone is high. On the demand side, let's go to the 60-minute chart for a moment. Okay, so we have a smaller time frame level here on the 60-minute chart sitting just above current price. And don't forget that weekly area is up here, 92.30 to 50. And there's that. And let's look here. Yeah, this level's much lower. So we'll come back to that one another time. But sitting around 90, 60, we have a demand zone with some secondary evidence. I know we've gone over that a lot in these sessions. All right, let's move on to, let me look in the chat here. Yep, we can definitely look at the euro. Okay, do you want to look at the euro futures? You want to look at the euro spot? It really doesn't matter to me. We can start with the euro futures here, and if you want to look at the spot, we can do that. So here we have, let's go to the 60-minute chart. So on the looking at the 60-minute chart here, we have a potential demand zone down here, 118.68. That's a gray demand zone. So we color code our supply and demand zones based on probability. And for those of you that been through our program, our courses, you know, it comes down to structure and location. Structure and location define probability. Where is that supply demand zone with regard to supply, demand, and fair value? That's location. And then structure, does it meet the criteria for, you know, structure that we need to see to, um, you know, have the evidence that tells us there's a big supply demand imbalance there. Okay. So that's that. And then we also have a supply zone sitting above this range, which is key. That's up in the 120.32 area. All right. So having our supply zone above this is very important. Remember the picture of fair value that we looked at? The presence of lots of trading activity and all this wide and whippy trading activity, right? See how that shows up here? Versus this is very different. Price is trading here for a short period of time and then falls in strong fashion. That is a footprint of banks selling euro up here. And now whoever's selling up here, did they sell all that they wanted to sell? Did that whole order get filled? Whoever wanted to sell up here or orders? No, they didn't. No, whoever, you know, not everybody that wanted to sell up here was able to. How do we know that? Well, because if that statement wasn't true, everybody could sell here that wanted to. Price would just keep trading sideways, wouldn't it? Wouldn't price just stay here? It would, but it couldn't. In fact, it fell pretty quick, suggesting a bigger supply-demand imbalance here. All right, let's move on to another market, and I'll try to stick with markets you want to look at. Let's go on to, how about the Aussie dollar? And we could switch over to the spot market. Again, no, we could just look at any market you want. It really doesn't matter. Whoops. There we go. Okay, so price keeps coming down to this demand zone that we have on the daily, and we probably wouldn't want to buy here again. The fresh zones are down around the 73.85 area. Okay. On the supply side, price is just sitting into this little demand zone here, but on the supply side, price almost came back and touched our zones up here. We have 2 or 3 zones stacked on top of each other. So if the Aussie dollar should rally up again to the 78.50 area, we'd look for it to turn and turn lower from there and move back down through all of this novice space here. Okay. Let's keep going. Yeah, the SPY, we can certainly switch it up and go over to the, we can certainly go over to the SPY. Let's do that. Right here. So for those that don't know, the SPY is the ETF for the S&P, meaning if you want to trade the S&P like a stock, the SPY is what you would look at. On the supply side here, or retail prices, we almost hit our zone yesterday, and this is up in the 394.50 area. Now, as a whole, we're not really big on shorting the stock market. There are times when it's appropriate, but we're always much more interested in buying at demand zones. Okay. And that's because the equity index markets around the world are designed to go up over time. We can have a whole nother session on that. But either way, 394.50, we'd expect the market to have trouble going higher and likely turn lower. So that's the SPY up there. And then on the demand side, we're going to go to a different chart. Let's go to the one next to it here, the 120. So on the demand side, and this is not a high probability zone, but there is likely to be some gap demand around the 383.40 area. Notice the gap there. Okay. All right, so hopefully that's helpful in the SPY. And let's go to, well, again, we can really go anywhere we want. Stocks, futures, Forex, it doesn't matter. Any market. GBP, NZD, we can look at that. It is flying. Let's wait for this chart to come up here and we'll take a look. In fact, let's bring up the large time frame here. So we'll always start with the large time frames, right? Just to see kind of where price is at location wise. Right, so we can see we're getting a huge move in this market today. And it's taking prices back up into the origin of a drop in price. So much closer to the supply side here than the demand side. Having said that, let's we need these, this PD, just for those that don't know, means pending data. So we're waiting for data to come in here. Not sure how long that's going to take, and I know we're running out of time here. So why don't we move on to another market where we don't have to wait for the data. Let's go over to the NASDAQ. Sure, we can look at the NASDAQ. No problem. So the NASDAQ, let's take a look at this chart right here. Okay. So we have a supply zone up here sitting above this range, all this fair value or novice space sitting around the 13,380 mark. This one down here, see how it's a circle? That's a low probability demand zone. But nevertheless, it is the NASDAQ, and the NASDAQ's been pretty strong. So we're looking at 12,920. We would not suggest full position size on this level. And it's okay to skip this one too and go with a fresher level, below this zone. But anyway, there it is. And that's what the circle means. That's an overnight demand zone. So certainly be careful with that one. And sitting below all that, in the 12,600 mark range is a is a gray demand zone here. The high probability levels are the yellow zones. So we haven't really looked at one of those yet. Have not looked at one of those yet, but anyway, I know we're kind of we are over our time here. Whoops, there we go. Yeah, so hopefully that was helpful. And again, the main purpose of today was to really dive into why do the majority of traders out there lose money? Why are the majority of people not successful at this? And it's because they simply don't think the market's the right way. Any strategy you're thinking of getting involved in or trying out, you want to run them through a filter of, whatever you're thinking of learning. It's always best to think, is this strategy you're about to learn or think about or execute, is it in line with how you make money buying and selling anything in life? And if you want to come to one of the advanced workshops here, I just put the link in the chat. There it is. These are free, and obviously these are these will take all this stuff that we're talking about quite a bit deeper. And on that note, hopefully that was helpful, and we'll see you next time. And next time we'll spend the majority of our time focused on the live markets, applying everything we talked about today. All right, have a great day, everyone.